Alright everybody, welcome back. I know it's been a little bit. Sorry, I had some other things to get through before I made the next video to this series. So we are still on the MotherFunded boot camp. And today we're going to be discussing sort of a continuation of what we discussed last time. So went over swing highs and swing lows last time. So I want to kind of go into when we talked about liquidity sweeps. So I want to kind of go into combining those two, and the next topic I want to discuss is called break of structure. And this kind of combines, that liquidity sweep and swing high and swing low aspect of it. So basically, a break of structure is when a current market trend, either decides to have a little bit of a pause, or of a retracement, or an altogether reversal. So to kind of get just a rough depiction of what I'm talking about, let's say we're in an uptrend. Right there. Let's do a little bit. Let's make it just a little bit more. Let's see. And it's not the greatest, but it'll do for this situation. So, as we can see, this is an uptrend. Now, obviously, we have a little bit of, retracements, but we're not going to pay attention to that. So when we see an uptrend and we see, let's classify these as swing highs and these as swing lows, we see that swing highs get, swept, and we see swing lows be kind of left intact because, they should support price, sort of like right here. So when we have a swing high that does not get swept, why is this all the way over here? Oh my gosh, this thing is tweaking on me. I swear, as soon as I start videos, it starts tweaking. So as soon as we have a swing high made here, and let's say this one doesn't get swept, what do we have right here? Here's a swing low. Like I said, if we classify these as swing highs and swing lows, and I'll kind of just, mark them like this. Let me change this to black, all this to black. Why are we still tweaking? Yeah, I think I'm going to change these all to black. Just for the purpose of the example. I am not a master at TradingView, so if you know faster ways to do this, let me know, so maybe I won't make you as frustrated. But anyways, so there's a swing low right here. I'm gonna do that with red. Got another swing high right there. Green. Swing low. And swing high. Kind of see, where we're kind of going with this. But, so let's take this swing low because this is the one we're really talking about. So let's say price is moving up, it's breaking swing highs, and it keeps going higher, 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 and then it creates a swing high and then kind of falls and it breaks a swing low that was made previously within this uptrend. Now what do we kind of have? We have a break in structure. Now there are two ways to classify break in structures. There's a break in just the current trend that we're in right now, and then there's an overall market structure. These two have very different impacts. One could just mean a retracement is about to happen, and then price could resume back in the direction that it was going, or it could cause an all-around reversal and come down and sweep where this current trend started. So that's essentially what break of structure is signaling to us. So when we understand this, when we understand that break of structure is when swing lows and swing highs are violated after they have been created throughout a current market trend, we can clearly see if this swing low was broken, where is the next obvious place that price is going to want to seek in this market environment? This one down here. So yes, we might have retracements. So let's say, for example, let's do the opposite side. So boom, right there, it might come up there just a little bit and then continue lower. And then we might have another little retracement up here, and then it'll continue lower until we have a balanced price range, because that's essentially all that these markets do. We can see this is all a downtrend, so there are imbalances within this. So what has to happen? We have to have the same thing on the opposite side of the direction. Doesn't mean it's going to happen immediately, but more often than not it is going to occur, because that's what these markets are basically made to do. As we can see, when swing lows are broken in a downtrend, we can clearly see that there is continuation. So let's do this. And when swing highs are created, they're left intact, right? So it's just the opposite of what we saw in the previous example with an uptrend. Let's just mark these for the purpose of completion. Boom. There you have it. So you have multiple breaks of structure within this, but the initial one that we're worried about is the one that breaks the current market trend that we're in. So if we were to maybe let's do this. If we were right here and we were wondering, where the next break of structure would occur, where do we think that is? I'll give you all a second. If we wanted to shift back to, let's say, an uptrend, where would that occur within this leg down? Then this price leg down. Occur here, occur here, occur here. If you said here, you would be correct. So as soon as we have a swing high, or even any type of candle, I won't even classify it as a swing high. A swing high that breaks it is definitely going to be really good confirmation, but all it has to do is have a candle with a body, or I would say it does have to close, the body does have to close above the swing high to kind of validate it, because we can have something like wicks where it's not as strong, unless you have really strong conviction. There's no examples of it right here, but we'll go down into lower time frames and we'll get some examples, and maybe we'll come across what I'm talking about. But just to play everything safe, because we always want to have the strongest edge when we're trading here, we want to see a candle body. That means if we're in a downtrend, we need an up candle, so a blue candle with a body. So here's a swing high right here with a body that closes above this high. Where does that occur? Which candle does that? Which candle has a body that closes above this line? Right here. Boom. Exactly. So right here would be the break of structure for this leg right here. And now we can start looking at potential upside targets. Like I said, target swing highs old swing highs, and like I said, relatively equal swing highs, like we said. So that's pretty much it. Like I said, all we are essentially trying to do is determine where there is a shift in market structure and where the next draw on liquidity is. And how this works is, like I said, breaks of structure between swing highs and swing lows. So let's go down to a lower time frame and let's pull some examples of swing highs and swing lows. Or do you want me to type this out? Maybe I should type this out. So break, I'm going to abbreviate, or let me do this. Break of structure, and I'm going to do BOS, break of structure. Okay, to, let's see, bullish BOS, current trend is bearish / down, must have a bullish candle close above most recent swing high within current trend. And for bearish break of structure, the exact opposite. Current trend is bullish, must have bearish candle body close below most recent swing low within current trend. Okay, so we got that. Pretty basic. And I know I say pretty basic, and it might sound like a foreign language to you right now, but I promise, if you just go into your charts and do the examples like I'm about to show you here, it's going to get a lot easier. So let's see. This past week's price action wasn't that great, so let's just look at here. Sorry about that. So as we can see, let's take this right here. So let's take from here down to here, and I'll mark that. Actually, I'll mark it with a box. So we're looking from there down to the lowest swing low, which is right there. Okay, I'm Mr. Popular right now, apparently. You'll see that? What about that? That make it better? A little darker? A little darker? Okay, right there. So from this swing high to this swing low, we can clearly see the market is currently in a downtrend. And so we can clearly see there is a, like I said, it doesn't come all the way back up here, but we do have somewhat of a shift in the current market structure. And where does that occur? Well, if you look right here, we have a swing high, and we can clearly see this was a very good turning point. Because why? Because out of all of this other price action, there's a tiny one right here, but as you can see, that fizzles out. And you will start to understand, based on market experience, based on time of day, based on, the current environment that you're in, that some breakup structures are going to be more lucrative to, price action than others are. So, just because you see a swing high doesn't mean it's automatically going to try to take out, the original, starting point of this current downtrend. But if we can see right here, boom, we have one candle, a second candle that's higher than the first candle, and a third candle that is lower than the middle candle, so this classifies as a swing high. So when that gets violated, or that has a candle body that closes above here, we have a break in market structure. And as we can see, we have some, okay, I'm freaking, this thing is tweaking on me, I don't know why. But we have, a reaction out of here. And what do we have right here? I know they are not exact, but this can be classified as equal level highs. So this is a very strong draw on liquidity. Yeah, we'll do that, I guess. Same with this. So as we can see, once price breaks this current market structure, we can see that it seeks the opposing liquidity from this leg down on the opposite side. Like I said, it doesn't have to, you should never ever, demand that something, is, as precise as these markets are, it's not going to be perfect. As, like I said, if your target is all the way up here, but you get, from here to here to here, this should be satisfied enough that you can find a trade that to be profitable with. If you get good enough, you don't need to hold, like obviously if you get all of this, that's great, but you don't need to have all of that to be profitable. So let's kind of do the opposite of what we were currently doing. So basically, why did my chart just, I don't get this thing sometimes. One second. Technical difficulties, everybody. Come on. That's NASDAQ. We're not working with NASDAQ. We're working with the S&P. Okay. So we got that. Let's go back here. Back. Where we are. There we are. So let's take from this leg, where it was the lowest point within here, and we kind of had a reversal. Not a reversal, but kind of a retracement. So let's take from here to this point, because as we can see, we kind of have a, a little continuation of, this. So right here, let's notice where we kind of see, this thing kind of start falling out of bed and gaining some, momentum. What do we have right here? Look right here. We have candle 1, candle 2 lower than candle 1, and candle 3 higher than candle 2. So this classifies this as a swing low. Boom. When we have a candle body closed below it, this is that break of structure. And what does it seek? It seeks, the opposing area liquidity. And what is this right here? These two. 1, 2. Equal level lows. Boom. That's a very, so if price is up here and you see it break this, current market structure, obviously, like I said, don't have to demand it come all the way down here. So, you can always aim for, this swing low right here, because this is technically a swing low. You can aim for this swing low right here. Like I said, when you get good enough, you will be able to be profitable and be wrong. And I know that's kind of like an oxymoron, but it's true. You don't have to be right to be profitable. You have to be smart, and you have to understand market and price action and market structure, but you don't have to be right. So that's why I'm saying, like, these are just high probability areas that we use to be able to essentially predict where price is going to go next. Because nobody knows 100% where it's going to go. And if they do, and if they tell you that, run away from them, because they're trying to scam you. If they say this thing is a for sure thing, don't believe them, because nothing is a for sure thing within these markets. It never is. So let's just, try to see if we can't find, some more examples. I'm not going to do a box here right now. Here we have one right here. Swing high. Because what was the current trend before this? It was down. And then we have this break it up here. What we have this swing high, we have this swing high, we have this swing high. These two I would classify as relatively equal. So here's a high probability draw on liquidity. Oh, here's a great example. So I know these aren't, like I said, technically, so this one we talked about, equal level lows, and this one is lower than this one. But I like well, I mean, you could classify this one, I guess, a little bit too, because this is technically a swing low. So I mean, this is a very valid pool of liquidity in my opinion. So when price is all the way up here, where are we looking for this thing to turn and start seeking something to the downside? Well, we have this, and then we have this, and this doesn't get down to there, so I mean, and this sweeps both of them, so I mean, holy cow, we got a pretty strong break of structure right here, because we have equal level lows being broken, and these were the first two lows after this huge up candle right here. So I mean, you can use either one of these to classify a break of structure. If you wanted the extra confirmation, then you would need, this would be valid. But as we can see, as soon as this happens, I mean, yes, it doesn't happen immediately, obviously, but I mean, you understand, if you, have been in the markets for a little bit now, that things don't happen, immediately that you think they will. But anyways, as we can see, boop, perfect down here. And like I said, more like it's gonna happen a lot of the times that you're right, but like I said, you never should demand that from the markets. And I know there's like small little examples here. Obviously, if you notice that if it's like it's sort of like this, like right here is a perfect example. Yes, did it work out, but would you trust this? Like, I mean, technically we had the candle body close right there, and it does break the structure, but I want to find one where there's a wick. Only a wick, no candle body closing. And then, like I said, obviously, if you notice that, like this, I guess, yeah, this one right here is perfect. So it happens right there, technically. But right here, is where I'm saying, we have a swing high right here. And we have a swing high right here. But, these are, I mean, it doesn't, yeah, we don't have a candle body a close above this high. We have a wick, we have a wick, we have a wick, we have a wick. And so, I mean, this is where you have to be smart and be like, okay, no, that's not really a valid, break of structure. This would be a valid break of structure, and then we can see the actual reaction out of here. Obviously, this candle was news, I think. Yeah, it was some type of news or something like that. So this created that type of movement, but as we can see, when the real break of structure happened, that's when the movement actually occurred. So yeah, like I said, you have to, be smart in the sense that you have to know, or not know, but you have to have that feeling of, that this is, valid at the end of the day. And obviously, if you, have higher time frames that you're studying along with the lower time frames, because just because there's a break of structure on the lower time frame, like say the 15-minute, let's say, let's take an example. So let's look right here. So on the 4-hour, right here, this is pretty bearish from here to here. That's pretty bearish, wouldn't you say? So if we go down, and let's just use from here to here, we go down to, let's say, a 15-minute time frame, and we see a break of structure on the 15-minute time frame. Clearly, this has a break of structure because we have multiple swing highs that have handle bodies close above them. Doesn't necessarily mean that this thing is going to come all the way up here again and reverse. No, because look what happens. It just gives up the ghost again. Obviously it's reversing now, but we also have to understand the difference between short-term, medium, and long-term highs and lows. We'll get more into that, but that is definitely one of the most confusing topics of market structure, because everybody has their own different opinion. Why is my mouse frozen? Did my mouse just die? I think my mouse just died. Huh. Great timing, right? Hold on 1 second, guys. Okay, we're almost done anyways, but okay. Like I said, perfect timing, right? So, I mean, like I said, we're going to have to understand a little bit more about market structure between long-term, medium, and short-term highs and lows. But when we combine those two, we're going to see, you know, a huge paradigm shift in our perception of, you know, how to determine, you know, market structure change and, you know, changes in current trends and reversals versus retracements and all that good stuff. But, you know, the homework for tonight is going to be, let's do it right here. Homework. We love homework, right? And if you don't love homework, then you're not gonna be successful with this, because this is gonna take some time. So I want y'all to identify, I can't spell, 3 examples of break of structure. Actually, we'll do 6 examples, because I want 3 of them to be bullish, which means break of structure to the upside, and I want 3 to be bearish. So go into your charts, go into whatever time frame you want, pick the time frame that you like the best, that you prefer, that you know you think you're going to be trading on the most, and determine, you know, 3 examples of bullish breaks of structure and 3 examples of bearish breaks of structure. And then next time we will discuss some more market structure between intermediate and long-term and short-term highs and lows. But other than that, that's basically all I have for y'all. I hope, you know, this was somewhat clear to y'all. Obviously, the more times you watch it, the more times you practice, and the more examples that you do, you're going to get better at it, just like anything else. But until next time, this is the MotherFunded Trader, and we out.